Welcome everyone. For those who don't know me, my name is Ashley Shield. I'm one of the executive directors of Jonge, based in our Melbourne office. Today, what I thought we'd do is have a look at, we're 6 months into the year, or just over now, obviously. So thought we'd have a look at what's been happening in the marketplace, some of the things that are causing everyone a bit of grief, and what can be done to help protect it a little bit against that. So we'll have a look at that. Unfortunately, you do have just me again today, but I'll do my best to make it as entertaining as I possibly can. But please feel free to unmute and ask any questions as you go along today. I'd like these to be a little bit more interactive where possible. So I thought before we get started, we'll just talk a little bit about what's been happening over the last 6 months. And certainly from a corporate insolvency point of view, we are seeing a real increase in the number of insolvencies. I don't think that's any surprise to anyone listening. We've certainly, the press is certainly saying that there's a lot of stress and stuff going on in the marketplace. To give you an idea, year on year, insolvencies are up about 16% from a corporate insolvency point of view. From a personal insolvency point of view, though, we are well behind traditional long-term trends. So you'll see a lot in the marketplace that says, oh yeah, we're on a rise and all the rest of it. When you compare against last year and the last couple of years, there's no doubt that we've had to rise because we've gone through probably one of the quietest periods in the history of insolvency. But when we look at long-term trends, to give you an idea, the long-term average for personal insolvencies is in the vicinity of 23,000 per year. Now, this last 12 months, we'll be lucky to hit about 11,000 personal insolvencies in the 23-24 year. We're still only 3 weeks in from the end of the financial year, so some of those take a little time to those stats to come through. But it's looking like it's going to be about 11,000 personal insolvencies. So that's less than half what the long-term average is for every year. Now, we'll talk a little bit later this morning about why I think that's happening and what the impact of that will be moving forward. But at a corporate level, we're back up well above those long-term averages. And I don't expect that that's going to let off for probably a good another 12 to 18 months, I would think, before we start seeing some normalizing. The level of pressure that is coming on businesses, I think, is actually ramped up again in the last month or two. And I think we're going to see that continue for at least another 12 months. Now, one of the other things that popped into the press in the last month is that you may or may not have seen talk about changes to the personal insolvency. They announced a couple of weeks ago that they are looking at changing the personal insolvency, the threshold at which you're able to bankrupt someone from $10,000 to $20,000. Now, that hasn't come into play yet, but we do anticipate that it'll come in somewhere in the next sort of 3 to 6 months, just going through various advisory and bits and pieces. So there's 2 things primarily they're looking at. One is to increase the threshold from 10,000 to 20,000. And they're going to extend the notice period of bankruptcy from 21 to 28 days. 2 things I think that is good, because I think it will make some people negotiate at those smaller amounts more than actually just pushing people into bankruptcy. But the other side of that is that what I think you'll find is that some people who really want to get it done and really want to get people bankrupted, and their debts are under that 20, they will push to get it done earlier rather than leaving it till the change in law, which will make it more difficult. So you may see a little bit of a push, particularly in that thresholds around the 10 to 20 mark, where people are going to push to put people into bankruptcy to get it done quicker before the change in the threshold. So just something to keep in mind if you've got any of your clients who've got some smaller debts. that that are around that threshold level, you may find that they get pushed into dealing with their bankruptcy earlier than they otherwise would, because they don't want to miss the opportunity when the threshold changes. So they're probably the couple of things that I wanted to say in terms of what's happening in the market. The last couple of months, and particularly in the last month, what we've seen is a really aggressive increase in the use of garnishee notices. Now, I've got to give you an example. I've got a client that I'm working with at the moment out of our Melbourne office that in 1 week. Now, this client's got a number of companies that are all in a little bit of distress. We're working our way through a number of things with them. However, in 1 day, he received 5 garnishee notices for 5 different companies, or 4 companies and him personally. So they hit the button and went really hard. I think in the last 2 weeks, I think across probably about 15 different clients, we've seen garnishee notices issued. Now, 6 months ago, I hadn't seen a garnishee notice for a very long time. So they're certainly starting to use garnishees as the new tool. And to give you an example of how dangerous they are, so the client that I had that I was talking about, who got the 5, he had it was a 50% garnishee of any money that was in the bank account at the moment. So he obviously running a little bit close to the wire. Wages were about $500,000. The garnishee came out the week before the wages came, and so he had all the money in the bank account ready to pay the wages. The garnishee notice came, and 50% of that money was taken out of the account straight away by the bank. So that's a really big chunk of change to have taken out of someone's cash flow instantly. Yeah, sometimes you're going to be luckier and you're not going to have as much in the bank account on that point in time garnishee. But in this case, it was, excuse me, a fairly significant amount of money that was taken out of the account, which obviously has a massive impact on his ability to pay his wages when they came due. We had another client just last week who was actually looking to engage us. The day before he was looking to make his payment to us, he got a garnishee notice and had his bank account garnished again. 50% of the money in the account got taken, which again is something unusual that they've actually increased the garnishees to 50%. We used to see them around the 15 to 30% as a first attack. Now, this client actually paid his payment plan on time. So his payment was due, let's call it on the 5th of July. He made the payment on the 4th of July, but by the time it got through the ATO system, it didn't get recognised as a payment till the 8th of July. So therefore, in the ATO's mind, he was actually late on his payment plan, and being late on the payment plan, within their computer system, it obviously flagged as a non-payment, and then they issued the garnishee within that time frame. So something to be really mindful of is how quickly they're starting to act and move now. And those things can have significant impacts on people's businesses. So that's certainly something we're seeing a lot of. I've spoken ad nauseum about director penalty notices, and we're seeing a real refocus on going after those again. And I'll talk a little bit later about the personal impact of the director penalty notices. But we are seeing them have a bit of a resurgence. I'd say there's probably 3 months there where we didn't see a lot. And now they're really starting to ramp up again. So certainly, if you're not sure, I'm happy to have a phone call with you afterwards, or you can find the old webinar of how you can actually look them up, how you can look up what might be coming for a client through the client's MyGov portal. Really important thing to have clients who have any debt going on, to continue to be looking at the continue looking at their MyGov portal every week so that they can stay ahead of anything that might be coming. Now, if I was to sort of try and categorize what we've seen in the last 6 months and something that I think that to be really aware of moving forward, is the fact that we're still seeing a lot of clients who are coming to us with very little time to do anything about it. We've got DPNs that are 2 weeks old because they're waiting for it to come in the mail. We're seeing creditor stat demands that are being issued for, now for those who aren't sure what a creditor stat demand, the ATO, because clients self-report their debt, they don't need to go through the whole statement of claim, go for get judgment and get default judgment and all that sort of thing in their process to be able to chase a company. Because you self-report, they have the ability to go straight to a creditor stat demand. Now, what a creditor stat demand does is basically says that from 21 days of service of the notice or receiving of the notice, that if you do not pay the debt, that your company is now deemed to be insolvent. Once that occurs, the creditor has the ability to go back to court to initiate wind-up proceedings. And then once those wind-up proceedings start, the director loses the ability to appoint their own liquidator. Now, they can still appoint a voluntary administrator, but there are a number of issues that come along with that. So we're seeing a real increase of clients coming to us with creditor stat demands very late in the notice, director penalty notices very late in the notice, but we're also starting to see the wind-ups. Now, I spoke at the start, and I've spoken probably at just about every webinar this year about how we're seeing a real increase in the court activity. But what we're seeing is that when a creditor initiates wind-up application proceedings in the court, they don't need to serve those documents on the client very early in the piece. At the moment, if you're applying for a wind-up application, it will probably take you on average 5 to 6 weeks, depending on the state, to actually get a date in the court. But that doesn't mean that the company is being told about it, or the directors are being told about it until about 2 weeks before. So you lose a lot of time and a lot of ability to assist and help a client when you're getting that late notice. Now, if they happen to be a client of ours, we have them on a watch, and with ASIC, you can set up an account that any changes on a client's ASIC file will tell you instantly if there's been any change, and a wind-up application is considered a change. So it is something that you can look at putting in place. We do it for all of our clients. I know some accountants will do that as well. So that when anything changes on an ASIC record for one of their clients, particularly where they're the registered office, then you'll see it before it actually becomes a paper lodgement, or before anything comes out to you in the mail. So we're seeing a large amount of this type of work where we're actually needing to deal with things within a week. And that obviously makes it very difficult. It can make it very expensive. Now, to give you an idea of what can still be done at that late stage, had a client probably about 2 months ago received a director penalty notice. He didn't receive it in the mail it took nearly the 15 days of the 21 days to get to his mailing address. Rang his accountant. Accountant said, "Oh, you're in real trouble. Give Jonge a call." We met with him on the phone at about 6 o'clock that night, talked through all the implications of it. As it turned out, it was a mechanic business. Had car lifts, had a lot of stock sitting in the factory and all the rest of it. We went out and met with them the next day and started planning towards putting the company into liquidation within the next 5 days. Now, I've spoken many a time and through many case studies talked about the fact that we often like to get business valuations, plant and equipment valuations, enter into a sale agreement, complete that sale agreement with commercial, with it being paid on commercial terms, and then put the company into liquidation. But with only 5 days to go, we don't really have that option. So what we did in this case, just to give you an idea of what can be done, was that we prepared the company and actually entered into a license agreement so that a new entity could actually start operating the business via a license agreement within 24 hours of us being involved. Then prepared the company for liquidation and put it into liquidation with the business technically still owned by the original company. Now, the reason why we did that was that under the license agreement, we wanted the right to buy the business. And then we were able to negotiate with the liquidator to purchase the business from the liquidator. We had a rough idea of the asset value, which wasn't enormously high. Pardon me, it wasn't enormously high, and the goodwill, it was a small auto repair business where there wasn't huge amounts of goodwill, because it was really the goodwill of the owner. So we were able to then do a deal with the liquidator to complete the sale, buy the business over, and then continue to trade while the company went through the liquidation. Now, the reason why we do things like that is that it allowed for continuity of business. But we also need to negotiate to move the lease. We need time to move the lease. We need time to get telephones and electricity and all those things done. And when you've only got 5 days, that can't be done. The risk for a client, and one of the reasons why I wanted to highlight this, is that obviously we can't be precise in what the price to buy it is. The liquidator has an ability to determine their own value for the business, and our client would have had to accept whatever that value is. So there is a little bit less certainty in it, but what it did do is actually give him a long-term benefit to be able to move forward. So when we're under duress and under time, there are still things that can be done, but they come at a cost for our clients and your clients that we need to work our way through. Now, he's been able to move on. There was a little bit of lockdown director penalty notice in there, and obviously we're dealing with that at a personal level as well. So that just gives you a little bit of an idea. The other thing that we're seeing a lot now is with wind-up applications on foot, and we're only getting notice of that. You have the option of entering into a voluntary administration during that period, or an SBR. Now, under both of those, the practitioner still has needs to turn up to court on behalf of the company. Now, depending on what state you're in, we're finding that the judges in each of those states, or the registrars in each of those states, can have less of the patience, I guess, to allow a voluntary administration leading to a deed of company arrangement or an SBR coming to an offer, where they're giving us enough time to have the practitioner put the offer up and get the approval of the creditors. So we've seen circumstances where the voluntary administration was appointed a week out, and then the court has said, don't care, let's just put it into liquidation anyway. They seem to have lost a lot of patience in allowing that the courts being filled up by these things progressing. Now, if you can put a good enough story together and it helped the practitioner by having enough of a story there of why it's going to be worthwhile putting off the winding up application and allowing the DOCA or the SBR to run through its process, you can then get the court to adjourn the wind-up hearing until after the meeting or before the meeting, where the court will make their own assessment. And then, if you're lucky enough, you can actually get the wind-up proceedings dismissed based on the fact that you've got your deed of company arrangement up, or you've got your offer up under the small business restructure. But I guess the point I wanted to let all of you know is that I've spent a lot of time on these webinars and when I've met with you all personally, talking about trying to get to things earlier. Now, I know that dealing with clients that are in these states isn't always the highest priority that you've got. You've got a lot of really good clients that are working well, and those that are under distress doesn't always mean that you've got time for everyone. But wherever you get an opportunity, please be mindful of anyone that does have a tax debt that isn't in a comfortable payment arrangement, that you are making them aware of the risks of leaving things unattended. Probably for 2 years, I've talked about having a plan B for these clients. And we spoke. I've spoken to you before, and I had one of my strategists on where we've had clients that didn't take us up and then came back later, and then we've had to deal with things quickly. But we are having. But the issue with that, obviously, is that you lose a little bit of control, and the timing can have a really big impact on what we can do to help. Now, one of the other things that I wanted to highlight that we're seeing, and this again is particularly coming from the ATO in this case, is the credit reporting. I have spoken about this before, but the impact of it in this last 6 months, I think, has been really a really big highlight, and that is that in very simple terms, the ATO, if a client is a company, if the ATO's client is a company, has a debt over 100,000 and is supposedly not engaging, and I'll talk a little bit to the supposedly not engaging, but in not engaging with you, they have the ability now to issue a default on the credit file of a client who is not engaging and has this debt. Now, in the modern world, I'm pretending that I'm old. Since COVID, I think you'll find that the credit reporting agencies and a lot of businesses are now, a lot more of them are a lot more sophisticated in having reporting tools in place that when a credit default comes in, that everyone is finding out about it very quickly. And we're seeing that significantly with clients' suppliers. When a credit default is issued, we're finding out about it within minutes, because creditors are calling their clients going, "You've got a default, I can't deal with you anymore." Two big areas that we're seeing that's having an impact on clients. One is there's a lot of clients we're finding are on cash flow finance, and they're using cash flow finance and debtor finance to keep running and keep their working capital flowing in the business. The minute that you have a credit default on your file from the ATO, what we are finding are that all of the debtor financiers are closing their door on finance from that date. So if you happen to have a debtor's ledger of 80 or 90, let's just make it a small one, $100,000 worth of debtor finance out there, you've got all of your debtors are paying in normal terms and paying it down. All of a sudden, if you've got a credit default that's come up from the ATO, they will stop giving back the 20% extras, because they have an outstanding debt of 100 grand and they want to protect their position before they start doing any more lending. So that can have a significant impact on a business very, very, very quickly. And again, I had a client, luckily it was a fairly small one. They had the credit default come through on his file. His debtor financier just closed the books. So he had, and in this case, it was only a small one. He had $10,000 in available funds, which he was due to draw down so that he could pay some rent and do some things like that. And the debtor financier said, "No, I'm not releasing it because I'm going to use it to offset my current outstanding debt to ensure that we're not caught by the credit default." So that can have us again, a lot of these things are very instant, significant impacts. So being aware of them is really important. The other thing, and I think I've spoken about this before, is the other part is that you have a lot of small businesses where the suppliers stop supplying when they get a credit default. And that can be a combination of two things. One is because they've got debtor insurance in place, and their debtor insurance is saying to them, if you put out any more credit to this client, we will no longer insure you. So therefore, they can't actually, you can't have a credit account, and all of a sudden you need to go to a cash account if you want to continue to trade with them. So we're the ATO, again, in this scenario, they'd sent out a letter to our client saying that if you don't do something, then we will issue a credit default. They had actually said that you had until the 26th, so up until tomorrow, but they ended up issuing the credit default 2 weeks early. And that obviously put go cat amongst the pigeons. So be aware if your client receives one of these credit defaults, there can be some significant impacts pretty quickly on businesses. So the next thing that we're seeing, and probably, and I know most of you as accountants who would be seeing this, you would be seeing this on the balance sheets as you're working through the end of financial year stuff now. We're seeing a marked increase in the amount of directors' loans getting higher. Now, again, I've spoken about it before, in the fact that because of the pressures of interest rates, cost of living, and to be honest, quite simply, the fact that profitability is going down, we're seeing a lot of businesses where the owners might be taking a salary, but that salary is no longer enough to support their families and their mortgages. So they're taking more out via a loan account. Now, most of the clients that I speak to don't actually understand what a loan account is. Don't understand that they're taking it out because they think it's their business, it's their money. We all know that it's a lot more complex than that. But for most small and micro businesses, they really struggle with understanding that. What that's doing is twofold. One is that you're obviously increasing the loan account, which has got its own issues, but it's also putting pressure on the businesses from their cash flow point of view, which is then leading to defaults on their ATO payment plans. It's leading to defaults on deciding not to pay super, and being late on paying other ATO obligations or just any obligations. So we're seeing it as clients are coming to us, and we're doing the analysis in preparation of coming up with a plan. We are seeing that certainly that loan accounts are increasing at much higher rates than I've seen for quite a while. Now, the reason why I bring that up is for all of you as we're getting through the end of financial year and you're starting to look at these things. If you are seeing a client's loan account drastically increase, or when you're doing the analysis, and we're talking with a client last week, the loan account hadn't increased on the balance sheet, but there are a whole lot of items that still needed to be reconciled. And that's where they've gone to Woolies to buy some food and they put it on the corporate card. They've done all of those little things that I know most of you don't have your cameras on, but I just saw the rolling eyes of Colin there. And all of a sudden they're starting, and they might pay their home electricity bill through the company accounts and all those little things that once it's reconciled, you realise that the accounts have gone up. To me, there's a really good sign there that there's pressure being put on the business by the director, and it may be worth starting to have those more serious conversations about profitability, about the ability to actually fund the business. I think, and I don't pretend to look at margins on businesses very often or closely. But what we do see is that margins are tightening, profitability is going down, But people are still trying to live the life that they led when they had more profitability. So if you're starting to see that increase, I think that's a really good opportunity to have a conversation about how you're actually going to be able to work through that. And I know I'm speaking to people who already understand this, but most of these business owners do not understand that impact. They're just trying to survive. So please be aware of some of those things. And that it leads into the next part of, I guess, what we're doing is that I wanted to talk about, and that's the personal exposure that we're seeing directors are being hammered by. We spoke last year about director penalty notices going through the roof, and for the first time of my history of being involved in pre-insolvency, and even going back into my accounting when I had my accounting practice, I've never seen so many directors ignore director penalty notices. We're seeing less of it now, which is good, but last year we saw a lot of it. And we have a lot of, we had a client come into us about a month ago, had a very, very successful labour hire business. This client decided he had a passion for another industry and started using some of the profitability from his labour hire business to funnel into a new industry. That industry was nowhere near as profitable. And he effectively borrowed across two companies nearly $750,000. But he was still living a pretty good life based on what he thought was the good lifestyle. Came to us, tax debt had blown out. The accountant recognised that, got us involved. When we spoke to them, we asked if he had a director penalty notice, and he goes, "Oh, yeah, I think I got one of those in November last year." We got onto the portal, had a look, and as it turned out, he had a $750,000 integrated client account debt. $300,000 of that was already a lockdown director penalty notice. It had already been issued against him personally. He had forgotten about it. He'd forgotten that by doing nothing in November last year, because he was of the opinion that the world would get better and everything would be okay, that he did nothing about it and he had this personal exposure. So the reason why I bring this up is that we're actually finding that we've got a lot of clients who have got sort of forgotten about personal exposure, and that personal exposure is starting to hit home now. As I mentioned to you earlier, I've got a client who had a number of garnishee notices issued against him. One of them was against him personally, because he had expired director penalty notices, and the ATO were looking for a way of trying to get their money. Now, that sort of leads me into what I think is probably the biggest risk for all of us when we look at it on a financial view basis. My personal opinion, and unfortunately, I don't have the internal forms from the ATO to be able to confirm or deny that this is actually going to happen. But my personal opinion is that we have an horrendous amount of personal insolvency or personal exposure to directors through director penalty notices, through other companies going into liquidation, and through people putting their own companies into liquidation, that we are going to see a significant increase in personal insolvency. Now, I think the fact that they're actually trying to change this mark from 10,000 to 20,000, I think the government has recognised that, and they're trying to limit it a little bit by making sure that an individual debt needs to be higher, so that they can try and not slam the market quite as much. But I think we're going to see a huge increase in personal insolvency, because the ATO is finding that they're not getting the results from chasing the companies, but they have already significantly attached a lot of personal debt to directors, and they're going to go after them. Again, when you're talking to your clients, I'd be asking the question if there are old DPN debts that are left out there, and I would start to be really talking about how you're going to protect yourself personally. whether actually going into personal insolvency can be structured or can't be structured. And having those conversations now, because if it comes into effect in 12 months' time, there's less that you can do. For instance, if you've got a family home, if we do need to sell the equity in the family home to a wife or a spouse that's not exposed to the personal exposure, having time to do that is really important. Trying to do it with a week or two's notice means that you're not going to necessarily get the benefit or have the ability to do it. I think we have seen an increase in inquiry now around that asset protection. They know that they've got creditors that are starting to blow out who have got personal guarantees, and they're asking to look at their personal asset protection and making sure that things are in place. Now, the problem is that most of the people who are asking us are the ones that already know that that's a risk and have already got some things in place, and we're just tightening some of the loose ends. Those who have done nothing about it in the past, there's a lot more work for us to do, so getting in early is really, really important. To be honest, I don't like being the scaremonger saying that the world's going to end and all the rest of it, because I don't think it will. There will be, as I've said to a number of you in person and in the past, is that I think there will be a correction in the market where a number of businesses are going to go out of business because they're not profitable enough. We're going to find a number of directors that are going to end up in personal bankruptcy because they haven't protected themselves properly. But there will still be a whole world and market and business that will continue on, and there will be those who will make a lot of money over the next 12 to 18 months. But we're going to have a lot of people who I believe will have their houses taken, that will go into bankruptcy and lose their homes and have to start again. And you've all heard the story of Hank, not getting the right advice and losing everything, and then having to start again. And he's done so very, very well. Now, we can all do that, but not all of us want to go through that process. So doing things early can be really, really important. The other thing which has led to some of this personal exposure and personal risk is that we're actually seeing with a lot of companies that are going into liquidation at fairly rapid rates, and not all of them in the controlled environment that we would love to say should happen. There are a lot of good companies that are being attacked by, so again, I've got a client in the food service industry, or not food service, they're in the manufacturing and food business. They've had 3 or 4 of their creditors actually go into liquidation where they've owed some money to them. And the liquidators of those companies that have gone into liquidation are being very aggressive in their attacking of them. In fact, for small amounts like $5,000 and $7,000, we're seeing creditor stat demands being issued by liquidators trying to chase debts down to try and get money back into the system. So with this higher increase in insolvency, where you might, for $5,000 or $7,000, you might have been able to negotiate a payment plan, or you might have been able to negotiate to give you some time, because liquidators are involved. And what a lot of those liquidators do is that they give it to a lawyer who specs the work. And therefore, we're finding they're doing a lot of it on a pro bono basis and getting their fee if they're successful. We're finding that a lot of our clients are now getting CSDs for debts that you would never have seen CSDs on before. So the whole insolvency market is, you can be a business that's in trouble. It's had one of your clients that have got into trouble, and now you're being attacked by another insolvency practitioner. That world is getting very tight. We're finding that the liquidators are being quite aggressive in chasing directors. So we're getting a lot of inquiry. We're getting some inquiry from people who have put companies into liquidation of their own volition, thinking that they didn't need the support, and now they're being attacked for insolvent trading, they're being attacked for uncommercial transactions, and now they're getting us involved to try and help manage and fight those claims. I could sit here and say to you that that's all a very big warning to that you need to come to us and go your own way. I'm not saying that, but we are seeing certainly a massive increase in aggressiveness. So look, I think there are a couple of the major points that I wanted to raise today. We're 40 minutes in. That's 40 minutes of you listening to me, and that's hard work. So I really appreciate everyone who's hung in there. I will open the floor to any questions. If anyone has anything that they want to ask, anything that they're seeing, either throw it in the chat or unmute yourself and speak up. More than happy to talk through anything that some of you may be seeing out in the marketplace and want to have some idea of what can be done. While I'm waiting for those people that may or may not be typing at the moment.
Hey, Ash.
Yes, Joe.
Yeah, if I can ask you a question around SBRs.
Yep.
So once a client goes through an SBR process, do they have to meet every single compliance lodgement after that date, or only through the process of getting the SBR approved?
Well, technically everyone needs to meet every compliance requirement every time anyway. So to go into an SBR, there's the ATO has some really strict requirements to actually have everything up to date. I've heard of them having to do half baths because of the timing and all that sort of stuff. Moving forward, a business's obligation. So say, are you talking about after the votes occurred and they've said that this is what our payments are?
Yeah. So it's been accepted, and now they're basically playing around with not meeting compliance requirements.
I think that would fall more into the responsibility of normal corporate governance of having to do the right thing than it would be specifically the anything to do with the SBR practitioners' requirements to keep things up to date.
All right, I just wasn't sure whether it was a condition of going through the SBR process that all future compliance had to be met on time, regardless of the fact that it's.
Yeah, I don't believe it's a requirement per se, apart from the normal corporate requirement to do it. And I think we'll know more about this over the next 6 months, is that we're finding a lot of people have gone into SBRs, got them approved, and now they can't actually meet them. And we're starting to see them starting to fall over and not making their payments to the practitioners as required. When the legislation was written, I don't think that was contemplated quite as heavily as it's actually happening. So there's still a lot of court cases that need to flow through to work out how to deal with that. And that may come part of it is the non-compliance in the future. But I don't believe it's a requirement that you make these payments and you meet all obligations, because that is your corporate obligation to do it anyway.
All right, thank you.
No problem. So just a reminder not a reminder for everyone, to let everybody know, we're about to run into our next seminar series where you'll get invites. Some areas have got invites that have gone out already. Others will be due to come out in the next week or two through late August and September. We're starting to run back into our breakfast seminar series or lunch seminar series. We've found that not everyone wants to do breakfast anymore. So please look out for those invites. We're madly working hard on putting that presentation together. We're very proud of those presentations and the stories that we tell and everything that comes up. So please look out for that. Jazz will now put up the poll for you to have a quick, if you can, for your comment. There doesn't appear to be any other questions coming through. I do appreciate you all listening in. Hopefully you're getting something from these webinars. If there is a specific topic that any of you would like me to focus on, if there's a guest that you'd like me to get in to talk about different things, please feel free to give me an email or give me a call. My email is Ashley, ASHLEY, at djra.com.au, and I'm more than happy to try and facilitate getting anyone in that we can to try and to help give you some of the guidance and help that you need. So we'll see what we can find and move on. But look, I think that's it. The webinar, the poll's up there and running. If there's no other questions, no other thoughts, we'll start to look at closing it up now. And thank you very much for your time. I really appreciate that, 45 minutes of your life you've spent listening to me. So I really do hope that you've got something from it, and that it can be useful back in your practice in any way, shape or form. So have a wonderful day, and we'll talk again soon.